Berkshire Hathaway just bet $37.9 billion on this stock. Berkshire Hathaway's recent investment in Alphabet in the U.S. housing market could have significant implications for investors. We'll break down the details of the investment and explore what it might mean for the broader market. What specifically will this mean for your portfolio? Berkshire Hathaway has upped its bet on the U.S. housing market and also boosted its stakes in Alphabet and Delta Airlines. The company owned about 106 million shares in the parent of Google, worth $37.9 billion at the end of June. This is a significant investment, and it's likely that Berkshire is betting on the long-term growth of the U.S. housing market. For example, if the U.S. housing market grows by 5% in the next year, Berkshire's investment could increase by $1.9 billion. But some investors might be concerned that this investment is too concentrated in one sector. And, with the current economic uncertainty, there's a risk that the U.S. housing market could decline. However, Berkshire's investment strategy has historically been focused on long-term growth, so it's likely that the company is taking a long-term view on this investment. Berkshire's investment in Alphabet is also significant, with the company owning about 6% of the company's outstanding shares. This investment could provide a significant return for Berkshire, especially if Alphabet's stock price continues to rise. In the last year, Alphabet's stock price has increased by 20%, and if this trend continues, Berkshire's investment could increase by $7.5 billion. But it's also possible that Alphabet's stock price could decline, which would negatively impact Berkshire's investment. We'll explore the implications of this investment in the next section. Berkshire's investment in the U.S. housing market could have significant implications for the broader market. If the U.S. housing market grows, it could lead to an increase in consumer spending, which could boost the overall economy. For example, if the U.S. housing market grows by 5% in the next year, it could lead to an increase in consumer spending of $100 billion. This could have a positive impact on the stock market, with the S&P 500 potentially increasing by 10%. But if the U.S. housing market declines, it could lead to a decrease in consumer spending, which could negatively impact the overall economy. In the last year, the U.S. housing market has grown by 3%, and if this trend continues, it could lead to an increase in consumer spending of $60 billion. Additionally, back in 2008, during the housing market crash, the U.S. economy experienced a significant downer. However, Berkshire Hathaway's investment strategy during that time was focused on long-term growth, and the company was able to weather the storm. Today, with Berkshire's investment in the U.S. housing market, the company is again taking a long-term view, and it's likely that this investment will pay off in the future. A common misconception about the U.S. housing market is that it's only driven by interest rates, but this is not entirely true. Other factors, such as employment rates and consumer confidence, also play a significant role. We'll explore the potential risks and opportunities of this investment in the next section. But first, let's take a look at how this investment could impact your portfolio. The part that surprised me most is what this does to your 401k. That is next. But the part that surprised me most is what this does to your 401k and how it could impact your retirement savings. For instance, if you have a 401k with $100,000 in it, and the U.S. housing market grows by 5%, your 401k could potentially increase by $5,000. However, if the U.S. housing market declines, your 401k could potentially decrease by $5,000. This is a significant risk, and it's essential to understand how Berkshire's investment could impact your retirement savings. In the next section, we'll dive deeper into the details of this and explore specific strategies to protect your 401k, including diversifying your portfolio and investing in real estate investment trusts, REITs. So, what can you do in response to Berkshire's investment? One potential strategy is to diversify your portfolio by investing in a mix of stocks and bonds. For example, you could invest 60% of your portfolio in stocks and 40% in bonds. This could help to reduce your risk and increase your potential returns. Another potential strategy is to invest in real estate investment trusts, REITs, which could provide a steady income stream and potentially high returns. In the last year, REITs have returned an average of 8%, which is higher than the average return of the S&P 500. But it's also possible that REITs could decline in value, which would negatively impact your investment. Additionally, a common misconception about REITs is that they are only suitable for institutional investors, but this is not the case. Individual investors can also invest in REITs, and they can be a great way to diversify your portfolio. For instance, the Vanguard Real Estate ETF has returned an average of 10% per year over the past 5 years, making it a potentially attractive option for investors. We'll explore the potential risks and opportunities of this investment in the next section. But first, let's take a look at how this investment could impact your overall financial situation. The key takeaway is that Berkshire's investment could have significant implications for your portfolio, and it's essential to have a long-term strategy in place. The key takeaway is that Berkshire's investment could have significant implications for your portfolio, and it's essential to have a long-term strategy in place. But what about the potential risks and opportunities of this investment? In the next section, we'll explore a surprising second-order effect of Berkshire's investment that could impact the overall economy and provide a unique opportunity for investors. Specifically, we'll examine how Berkshire's investment could lead to an increase in consumer spending and a boost to the overall economy, and what this could mean for your portfolio. One surprising second-order effect of Berkshire's investment is the potential impact on the overall economy. If the U.S. housing market grows, it could lead to an increase in consumer spending, which could boost the overall economy. For example, if the U.S. housing market grows by 5% in the next year, it could lead to an increase in consumer spending of $100 billion. This could have a positive impact on the stock market, with the S&P 500 potentially increasing by 10%. But if the U.S. housing market declines, it could lead to a decrease in consumer spending, which could negatively impact the overall economy. In the last year, the U.S. housing market has grown by 3%, and if this trend continues, it could lead to an increase in consumer spending of $60 billion. Additionally, a historical comparison can be made to the 2005 to 2006 housing market boom, where the U.S. housing market experienced significant growth, leading to an increase in consumer spending and a boost to the overall economy. However, when the housing market crashed in 2008, the overall economy suffered significantly. This highlights the importance of understanding the potential risks and opportunities of Berkshire's investment and having a long-term strategy in place. Another factor to consider is the impact of interest rates on the U.S. housing market. If interest rates remain low, it could lead to an increase in housing demand, which could drive up prices and boost the overall economy. On the other hand, if interest rates rise, it could lead to a decrease in housing demand, which could negatively impact the overall economy. The key takeaway is that Berkshire's investment could have significant implications for the overall economy, and it's essential to consider the potential risks and opportunities. Now, let's summarize the key points and provide an actionable next step. In conclusion, Berkshire Hathaway's investment in Alphabet and the U.S. housing market could have significant implications for investors. The key takeaway is that it's essential to have a long-term strategy in place and to consider the potential risks and opportunities of this investment. One actionable next step is to diversify your portfolio by investing in a mix of stocks and bonds, and to consider investing in real estate investment trusts, REITs, to provide a steady income stream and potentially high returns. Additionally, it's essential to understand the potential second-order effects of Berkshire's investment, such as the impact on the overall economy and consumer spending. By taking a long-term view and considering the potential risks and opportunities, you can make informed investment decisions and potentially achieve higher returns. To get started, take a closer look at your current portfolio and consider rebalancing it to reflect the potential implications of Berkshire's investment. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about Berkshire's investment, hit subscribe. I break down one of these every week.